When you learned about strangles, you learned that the strategy is really just the combination of a short out-of-the-money put and a short out-of-the-money call sold in the same expiration cycle. Because these options oppose each other from a directional standpoint, they create a range of profitability between the strikes when sold together. A short iron condor is no different, except here we're defining our risk. An iron condor is nothing more than a short strangle with long options that are purchased further out of the money to define our risk. In other words, an iron condor is nothing more than an out-of-the-money short put credit spread combined with an out-of-the-money short call credit spread sold at the same time and in the same expiration cycle. The long options reduce our credit collected on the trade since we're paying to insure the risk on the short options, but it's a very similar trade when compared to a strangle nonetheless. The best case scenario with a short iron condor is exactly the same as a short strangle. We want the stock to land between our strikes at expiration so all of our options expire worthless. Let's say if I would have just traded the strangle in this example here, I would have collected $5 from selling the short options, $3 on the put side, and $2 on the call side. If I wanted to define my risk, I could then go out and purchase a put and call contract to insure the risk on my short options. Let's say I go 10 strikes below my short put and purchase a put for $1. At the same time, I go 10 points above my short call and purchase a call for $1. Since I'm paying $2 in total to define my risk, my net credit drops from $5 to $3, but now I know my max loss. Both of these spreads are $10 wide, and I've collected $3 from selling the iron condor, so my max loss is $7 now instead of being undefined. See, I told you that you'd get it. Let's dig a little deeper and break down some characteristics of the iron condor. Just like other premium selling strategies, when selling an iron condor, we don't need to be directionally correct with the stock price. Giving the stock price a range to be successful has a higher probability of success than if we were to become long or short stock outright, where we'd need the stock to move in our direction to be successful. When selling an iron condor, our assumption is neutral because the directionality of our short spreads offset each other. This is conceptually the same as a strangle, except we have short spreads instead of short naked options. A short put spread is bullish, and a short call spread is bearish, but since we're selling both out of the money at the same time, we create a neutral range of profitability. Iron condor sellers benefit from an increase in premium and wider standard deviations when implied volatility is high. The higher the IV is, the further from the stock price we can go while still collecting a decent premium. We keep our risk in check with iron condors by comparing our credit received to the width of the spread. Just like selling options for a few pennies, we don't want to take on risk if we're not getting paid to do so. We usually try to collect around a third of the width of the spread with iron condors, which gives us a risk-reward ratio of around 2 to 1. In a high IV environment, we can move our strikes much further away from the stock price and still achieve this ratio. The max profit on an iron condor is simply the credit received from opening the trade. We want the options to expire worthless, as we can then keep the credit received from opening the trade as profit. For an iron condor, this happens when the stock price is between our short strikes at expiration. One of the benefits of selling premium on both sides of the stock price is that we can use the total credit received to improve our break-evens rather than just one side. Since only one spread can be in the money at any time, the credit on the side that is not in the money assists our break-even on the side that may be in the money. For that reason, we can use our total credit received from selling both the put and call spreads to determine our break-even on either side. We can add the total credit received to the call side to determine our break-even price there, and subtract the total credit received from our put side to determine our break-even price there. Max loss is simply the width of the spread less the credit received. It's important to note that this is not the distance between the short put and short call. It's the distance between the short put spread strikes as well as the short call spread strikes. If the distances are the same, our risk is easy to calculate. If they're different and the put side is 10 points wide while the call side is only 5 points wide, we have much more risk if the put side went in the money compared to the call side, because the put side has the potential to have $10 of value at expiration compared to $5 on the call side. Remember, we're selling this strategy, so we'd have to buy it back to close it. The higher the spread's potential value, the more risk I have. Let's review. An iron condor is a defined risk, neutral strategy because our bullish put credit spread is offset by our bearish call credit spread. The best case scenario for an iron condor is that the stock price is between our short strikes at expiration. If that happens, our options expire worthless and we keep the credit received up front as profit. Since we collect a credit, one of our short strikes can actually go in the money a little bit before we start to lose money on the trade at expiration. With that said, if one of our spreads is completely in the money at expiration, we will realize max loss on the trade, which is the width of the in-the-money spread less the credit received from opening the trade. Check out the written content for more information on iron condors, or proceed to the next section where we revert back to an undefined risk strategy called a straddle.